everybody for joining us this morning. I'm super excited about this class. We had over 100 people sign up for it. And I got some great guests today with Greg, Scott, and Michael. And before jumping in to the topic, I wanted to give you a little overview about our continuing education platform, myself professionally, and what we're doing with these live Zoom classes on a monthly basis. So as many of you know, my name is Pierre Debbas. I'm a real estate lawyer and founding partner of Romer Debbas, which is one of the top real estate transactional firms in the city. And we have built a lot of our practice through providing education to the real estate community over the years. And in this endeavor, I'm also co-founder of what has become the most elaborate platform for real estate education on the internet, the Real Estate Center for Success. Myself, along with my law partner, Michael Romer, and our dear friend and partner, Neil Garfinkel, combined forces to really create this platform where our goal was to provide relevant, timely, and the most important content to the real estate community for everybody to essentially enhance their skill sets and their professional, what they do on a daily basis. This class is something that we're doing, every quarter, talking about recapping the prior quarter that just concluded to give predictions for the marketplace, take data, anecdotal data, and apply it to where we see trends moving on in the future, which I think in a day like today is couldn't be more important. Our website, RE Center for Success, has on-demand courses available 24 hours a day through your tablet, smartphone, computer. You can purchase bundles. You can, if you have friends who are looking to get the real estate broker's license, there's a licensing class. And you can purchase individual classes depending on your needs for credits, and also depending if you're interested in the content. These classes I do every month for free is a courtesy to the industry. And as I said, it's something that I really personally enjoy, and I'm humbled by the caliber of co-instructors that we have with us. That's, if I were to think about what really differentiates our school from every other school, it's the fact that we're not providing generic, mundane content to the community. We are providing the most important content with the most successful people in the real estate business in New York City to all of you. So with that being said, I'd like to kind of go through, you throw it over to each of our panelists today, starting with Greg to give an introduction on yourself, and we'll go jump in right from there.
Morning, everybody. Greg Heym, Chief Economist at Brown Harris Stevens for the last 21 years. Before that, Chief Economist of Rebney. That's it.
Short and sweet. All right, Scott, let's see if you can use a couple more words.
Scott, I'll keep it. I'll do the same. Scott Vandermark, Senior Managing Director at Citizens Private Bank, where we have been up and running for getting on 2 years now. Formerly First Republic Bank, lifted out of JPM to come over to Citizens and build out an FRB-like private bank on the Citizens Bank chassis, and doing a lot of the same creative, complex, high-end residential mortgage lending. That was our hallmark at FRB.
Michael, you're up, my friend.
Nice job, Scott. And you too, Greg. And Pierre, you and your team are doing great work.
Thank you.
My name is Michael Vargas, president of Vanderbilt Appraisal Company, which we formed in 2003. So we're starting our 22nd year in business, performing residential and commercial appraisals in the tri-state area, with a heavy focus on Manhattan co-op, condos, townhouses, and happy to be here today with you guys.
Thanks, Michael. So the first thing I want to chat about, when you look back at the last few years, I think the most active segment of the market from our perspective has been the high-end luxury market. At the end of last year, I wrote an op-ed summarizing, what we saw from a transactional volume perspective in 2023. And the eerie thing, my suspicion was that 2023 mirrored transaction volume during the financial crisis. And obviously the economic factors of the two were drastically different, right? 2009, we thought the entire banking system was on the verge of collapse and, could have taken down the entire economy. And luckily we rebounded quickly, but if you all were doing this back then, transaction volume plummeted by a historic level in that year. Now, 2023, transaction volume, believe it or not, plummeted in the same manner. I believe the actual number came within 3% in terms of total transaction volume comparing the 2 years in Manhattan in particular. Now, the factors were different. That was really mainly due to the rapid raise of interest rates in an 18-month span, which nobody could have forecasted for. Now, where we saw transaction volume as a real estate law firm was the high-end luxury market. I at one point in time, I probably for an entire year, we had over 70% of transactions were cash. And our historical average in Manhattan in particular is closer to 50%. So where are those cash deals? We saw more $5 to $25 million deals than we ever saw. Unfortunately, the bulk of volume of transactions is in the $1 to $3 million segment, which was extremely negatively impacted from the rate environment. Now, I know 2024 stats aren't complete just yet. Greg, I'd be curious to hear your thoughts in terms of where do you think 2024 would land from a transaction volume perspective in comparison to 2023? And also to your thoughts on the high-end luxury market, the factors that maybe, if a boosted that market and where you see that moving forward.
Well, I think we all have to remember, we all read and get impressed by luxury, but sometimes we lose sight of the fact that more than half of the resale apartments sold in Manhattan sell for under $1 million. I think we forget that. And that's where the slowdown comes. When you think about what's affected by mortgage rates, under 2 million is the sort of the sweet spot, for lack of a better term, for that. So, 23 was a bad year. We know that. You had the greatest year and a half many of us have ever seen in 21 into the first half of 22. Things started to slow. They got really slow in 23. This year started off bad because the rates, had been rising into the start of this year. Then we had kind of hope at the end of we saw rates start to decline after hitting a recent high. They fell down to just about 6% at the end of September, and we all know what's happened since. So rates have really been driving, the middle to the lower end of the market. As you mentioned, cash has been king and more people. And look, we know what deals are dominated by cash: luxury sales, co-op sales, where co-op boards have their own rules about how much you have to put down. Overall, when all is said and done, it's going to be a slightly better year than 23 in terms of transactions. But me and Michael Vargas talk about this, the rare instances we get together. Prices are not moving. That's the weird thing about this thing. If you look at the last 4 years, when you think of everything that has happened, COVID shuts us down for 3 months. Prices don't decline. They don't crash. We reopen, have this great 21. Prices really don't go up much. Now they're trending down. Obviously, all segments don't move the same. But it's interesting, and I credit that to inventory. Unlike most parts of the U.S., we have inventory. I know a lot of brokers say, well, where is it? I can't. It's there. It's maybe nobody wants it, but and this goes to the luxury market. The luxury market is driven obviously by demand, but as much by new development coming on the market. We had 2 sales last year for closings for over $100 million, and they were both in new developments. That's pretty impressive right there. You don't see that often. If we look at sales, it depends how you want to define luxury. There's luxury, there's ultra luxury, and then there's just crazy, right? If we look at 5 million and over, the closings are down 7% from last year. Again, not all the data's in, but the average price is almost identical, which is maybe shouldn't be surprised. New development's a little different story. The average price for a new development over 5 million was up 14% this year. And look, those numbers are always, you got to view them with caution. You sign contracts sometimes years before you close. It's really about when they close, and they close in bunches. This year, 730 Fifth Avenue dominated, the top sales in the market. Some impressive resales, though, one at 220 CPS. Also, I think that obviously when the S&P 500 rises over 20% in back-to-back years, and people are starting to worry, are stocks overvalued? We're not winning the war against inflation. Inflation's sort of stuck in neutral. I think that people are always going to look to real estate as a secure, stable investment. But for a lot of these people, it's the opportunity. $135 million apartments don't come around that often. And it seems ridiculous to think, oh, how worry about housing people that can afford that. But I guess the best way I sum up 24 is it was better than last year, but so what? We're kind of back to the malaise of, to give Jimmy Carter a little bit of a tribute, of 2018 and 2019, where things were sluggish, particularly in the co-op market, in the high end. We see now, and Vargas can speak to this better than me, unrenovated co-ops are not selling. And if they are selling, it's for significant discounts. So I think that's kind of where we are. But and then we talked about rates and how they really control everything. I think people are starting to accept the fact that they're not going to get the rates they like, and the demand is still there. So, last week was a great week for contract signings in Manhattan. I mean, a really strong way to come out of the holidays. And contract activity in the last couple of months of the year was significantly higher than a year ago. Again, not the best year, but hey, it's going in the right direction. I think, what's going to get us out of this, obviously, if mortgage rates come down significantly this year, which I don't think they will, and, economic growth is good. The demand is there. Hiring is strong. Now, there's a lot of talk about layoffs, but we haven't seen any of that in the data. December jobs number was ridiculous. Consumers are still spending. You add all that up, you see demand there, and we have inventory. I think people will just say, you know what, the election's over. All the excuses I was giving, let me go ahead and do what I have to do.
One thing, and Scott and Michael, I want to get your thoughts on this as well. With not focusing on rates just yet, because that's kind of the second part of this I want to talk about. But I can tell you, when in Thanksgiving week, I use this anecdote all the time, is generally a quiet week in our business. It's 2.5 business days. Everybody's in holiday mode. They're traveling. I would say I love all these stats that we all use. My favorite stat is how often is my phone ringing, right? It's the most basic elementary stat of all time. My phone's ringing, it means things are picking up and activity is on the horizon. My phone rang 24 hours a day during that week, which is completely bizarre. In my 20 years doing this, I've never seen that. What I have seen in the last 2 years is that there's no rhyme or reason to the sporadic uptick of demand. I'd love to equate it to something, but it's completely sporadic. But the good thing was that interest kind of continued, not to the same level, but throughout December and this year, I am definitely seeing an uptick in inquiries, which is where, look, nobody calls a lawyer to, joke and have fun. As funny as I think I may be, they call a lawyer when they need them and they're ready to transact. And it's a good barometer for, hopefully a trend going into this year to have a positive, kind of spin on 2025. But with that said, Scott, I'd love to get your kind of thoughts on last year and what you're seeing and a few predictions for this year. Then we can talk about, get Michael's views and then go into kind of the myth behind rates and how they fluctuate.
Sure. So just to circle back first to something that Greg had said, which I think is spot on. I mean, the luxury market, tended to be where more of the action was at. And as we all know, and as Greg pointed out, the luxury market in part has been more active because it's more impervious to financing and to the cost of capital. At the high end of the luxury market, there's a higher percentage of cash buyers. But the other piece that actually does interplay with financing and with cost of capital is, for let's call it the affordable luxury category, up to $3 million. Your average buyer, your average consumer is investing, in some S&P equivalent that yields, in a decent year 5 to 6%. So if your borrowing cost is close to 7%, and your yield on investments is below that, that's a negative spread. That's going to negatively impact, your appetite to buy. At the high end of the market, I mean, there's a tremendous amount of wealth being accumulated over the last, few years among private equity, venture capital, hedge fund. And a lot of those folks, their opportunity cost isn't an S&P equivalent 5 to 6%. Their opportunity cost is 15 to 20% because they oftentimes have the inside track on private equity or venture capital and private investments that have significant upside. And so borrowing at 6.5% is still attractive to someone buying a $25 million apartment, because the opportunity cost is in the double digits. So we're actually seeing a lot of financing at the high end of the market, just because their opportunity cost is so much higher than the opportunity cost of the equivalent buyer in what we'll call the affordable housing market, which is 3 million and below. Back to rates more generally, there was and Greg touched upon this as well. There was a beautiful symphony of downward rate momentum, that had a lot of renewed activity and interest, and phone was ringing off the hook, to your point, Pierre. And then we had the election, and then we had inflationary policy discussion, and deportation and tariffing and deregulation, all of which have conspired to create an inflationary environment. And the Fed, to Greg's points earlier, the Fed cuts the Fed funds rate. That's the rate at which banks borrow from one another overnight. It has an influence on mortgage interest rates, but it is only indirect. The more direct correlation is to the capital markets, and probably the most direct correlation within the capital markets is the 10-year Treasury, and the 10-year Treasury is approaching 5%. And the consensus in the market is it's probably headed to 5.25%. Right now, rates with relationship are in the low to mid sixes. Rates tend to trade 150 over the 10-year, 150 basis points or 1.5% over the 10-year. So that suggests if we cap out at 5.25 on the 10-year, we're probably going to see, we're already seeing in the agency market 7% handles. But in the jumbo relationship market, which is still, you can still get in the high fives to mid sixes, that's going to start to approach 7% as well, as the 10-year breaks through 5%. And I think that's going to have a psychological impact, on the marketplace. And I think, could ebb, some of the positive momentum that we were seeing in the fourth quarter. But I also think that, Greg made a really good point, which is that, New York City is restless, and no one sits around on the sideline forever. And we're seeing decent activity, start to manifest here in the first, 15 days of the year. And I don't think regardless of what happens with rates, there's going to be activity. But I do think that rates are going to be, the marketplace is going to have to start to acclimate to the fact that we're not going to see 3 and 4% handles anytime soon. The rate market over the next few years, I think, is going to trade in a band of 5 to 7. There's going to be a lot of volatility depending on what policies actually get implemented and what the impact of those policies are. But I think the market will move regardless because no one in New York City sits on the sideline forever.
Thanks, Scott. By the way, before jumping to Michael, I just want to say if anybody has any questions, please put them in the chat, and I'll go through them and ask as many as I possibly can to everybody. But Michael, now we've heard Greg and Scott's perspective. I'd love to get kind of your thoughts on this topic too.
Yeah, I mean, going back to you started the conversation about the luxury market doing well. We can categorize that any number of ways, but I think from a boots on the ground perspective, we saw a good amount of activity in the 3 to 5 million and 5 million and up range for new, for the new development condos that are selling those types of units. And not, I wouldn't say, as Greg mentioned, I think, we saw kind of a similar end to the year, which is that, the overall prices are not necessarily up, and the transactions are, the total transactions probably ended up a little bit lower. But, relative to the rest of the market, that market felt busy. It seemed like more of our, appraisal assignments and our appraisal orders were coming over for new condo units And you sometimes gauge the market, from phone calls that you get and the types of contracts that you're seeing crossing your desk. And so we look at something similar where, what kind of mortgage appraisal assignments are we seeing most often? And then also, from when we're visiting, certain buildings, and we can see that, when the market is really bad for the luxury segment, meaning, new condos in particular, you can kind of feel the despair in the sales office as you walk through. But for, most of the different market segments, we saw, that most of these developments have reached adequate absorption. They have an adequate amount of demand, but none of them are in a position where they're raising prices. They might be cutting better deals, with in terms of concessions or payments of closing costs. But they're not cutting prices, they're not raising prices, and they're signing an adequate amount of contracts to move towards full absorption of those projects. And so we saw a lot of positive, momentum in that 3 to 5 and 5 to 10 million, condo unit market. Not improvement in terms of these projects being able to raise prices though. And I don't think that, we're looking at a situation where we're close to where, peak volume or peak values were during the, last segment of the new development cycle, 2016, 2017, 2018. But it's, relative to the market that's more impacted by mortgage rates, below 1.5 million or so. It certainly felt from the types of appraisal assignments and the work that we were doing for either cash buyers or for, mortgage applications, that was a strong segment of the market.
Thanks, Michael. So, one thing everybody talks about nonstop, right, is interest rates. And many people probably sick and tired of hearing about it. But in reality, that's our biggest factor, right? Like I did an interview the other day, and I'm like, there's no magic formula to how to spark a transaction volume. It's rates, right? Like, and we're sitting here in America, 70% of homeowners in the country have a rate sub 4%, right? So if you're saying it's not a rocket science to say, hey, if I'm sitting in a 3.25, why am I going to go trade, upgrade, or make a lateral move at 7%, right? Like, what possible logic does that make for me, right? So now when we look back at last year, we went into last year expecting the Fed to have 3 to 5 or 3 to 6 rate cuts. We didn't have one rate cut till September. Then we had 3 rate cuts in September through the end of the year of 25 basis points, which, is a nominal figure in reality, given how many increases we had. But mortgage rates have gone up since then. There's a conception in society that Fed cuts rates, mortgage rates come down, Fed cuts rates, mortgage rates come down. And that couldn't be further from the truth, albeit there's some correlation between the Fed rate, the 10-year Treasury, and mortgage rates. But Scott, I want you to explain to everybody, because this is a misconception I think everybody needs to be aware of, what actually impacts mortgage rates and what impacts the 10-year Treasury, and what's the difference between the 10-year Treasury and the Fed funds rate.
Right. So Fed funds is the rate at which banks borrow from one another overnight. The other thing that the Fed controls is the prime rate. The prime rate, is tied to home equity lines of credit, not first mortgages. So to your point, there is an indirect correlation between Fed policy and the movement of the Fed funds rate and first mortgage loan interest rates in our marketplace. What moves mortgage interest rates is a variety of things, and it's gotten very, very complex. It used to be, 10 plus years ago, almost entirely correlated to the 10-year Treasury. Now it's a confluence of geopolitical influences, the 10-year Treasury, Fed policy, bank capacity, levels of profitability in the industry. It's become a very complicated algorithm. But to boil it down and make it relatively simple, mortgage interest rates are tied to the Treasury market, and as the Treasury market goes, so go mortgage interest rates within the Treasury market. The 10-year is the most correlated among all of the indices. And right now, and the Treasury market responds to inflation, deflationary influences. And right now we are in an inflationary environment based on the presumption that a lot of the new administration's policies are going to actually drive costs up. And as a consequence, you see the 10-year Treasury go up. And as a consequence of that, you see mortgage interest rates go up.
Greg, what's your thoughts?
Well,
Scott, where do rates go this
year? You know, the thing is, first of all, this whole idea that tariffs are going to cause inflation is not true. Tariffs don't cause inflation. They cause the price of the good to go up potentially. But we've had, you know, President Trump had tariffs in his first administration. We didn't have inflation. A lot of those tariffs have been kept. That's not what causes inflation. Runaway money printing causes inflations and sometimes supply chain shortages. It was interesting to hear the Treasury Secretary finally admit that their excessive money printing, you know, raised inflation a little bit. It's one of the silliest things I've heard said, because to blame inflation on supply chain was nonsense. You raise the money supply 40%, you're going to have inflation. And, you know, the one thing to Scott's point about the federal funds rate, it's not used anymore. Now that banks are required to have all these reserves, they don't need to call another bank and say, we have to make our deposit requirements here. Can you lend me whatever? It's a symbolic thing, just a way to put the gas on the economy. The thing that scares me about all of this is we cut rates 1% last year, right? The federal funds rate. When the economy was growing near 3%, we were adding 200,000 jobs a month. The unemployment rate is sitting in the low 4s. Why the heck are we cutting rates? You know, I understand the fact, because, you know, I do have an economics degree, and anybody that follows knows this. It takes time for monetary policy changes to work, 6 months to a year before it filters its way through. Now we're in a bad situation. Inflation is not coming down. You know, core inflation came down a little bit and it was lower than expected yesterday. But, you know, you talk about what moves 10-year treasuries, a blowaway jobs report on Friday that had everybody stunned. There's not anything bad I could say about it. Every indicator in there showed amazing amounts of hiring. You know, wages are still rising. What happens? Rates shoot up and the stock market gets creamed. Yesterday, CPI comes out slightly below expectations and people get all excited. Now it's like Friday never happened. And that's what keeps happening in these cycles. So first of all, expect it to be very bumpy this year and very data dependent. You know, in my 32 years as an economist, I've never dreaded when data comes out like I do now, because you see and you go, oh, great, you know what this means. The Fed, forget about cuts this month and March. I would say forget about cuts for the rest of the year, but I don't think they're smart enough to do that. They have a problem now. They can't really do anything to get inflation lower. It's just going to have to work its course. But you've just cut rates by 1%, which is really stepping on the gas in the economy at a time when, again, GDP is growing near 3%. Retail sales came out today. They weren't as high as expected, but still decent. And who knew consumers could still spend money when they had $1.2 trillion in credit card debt at record rates? So everything's going to be driven by rates, like everybody keeps saying. It's going to be a bumpy ride. I don't think rates go near the low 6s for at least most of this year. There's no reason to expect inflation. Now, inflation last month was driven by energy prices, which had been declining. So anyhow, I think that the problem is we always used to joke that for the financial crisis, people bragged about what they paid for their house. Now people brag about the mortgage rate that they have. Right, I have a 3% rate. I'm never selling, which has constrained certain sectors of inventory. But at the same time, what is that? I'm looking at the question. If people don't raise the
Don't
price.
sweat.
Prices go up automatically when you increase the money supply significantly. That's the way it's usually worked. But I don't ever remember in the 32 years I've been an economist, the Fed cutting rates when the economy is healthy. Anybody remember that? No, you cut rates when there's signs of trouble. This was bowing to honestly, what the stock market wanted.
Now, Greg, real quick though, in the 10-year Treasury, federal spending goes down. Does that bring down the 10-year Treasury because the government doesn't need to raise or borrow as much money?
Not necessarily. I mean, one of the things the budget deficit numbers came out for last month, and if we're running a 40% higher deficit than a year ago because interest rates have gone up.
Well,
But
interest now is the largest line item on the federal government's, P&L.
yeah, because when you get it paying nothing on your treasuries, it's very easy to borrow money. It's like having a
Yep.
3% mortgage. You double that, or even multiply it by more than that, all of a sudden your interest payments become ridiculous. So I mean, that's part of it, but you also have to look at what's going on, most notably with the personal consumption expenditure price index, or core PCE. That's the final word on inflation. That's what's really going to drive. CPI has like its week, but everybody's going to forget what CPI said when PCE comes out at the end of the month. And we also get our first reading on fourth quarter GDP. That and the employment reports are as big a part of that as anything else.
Yeah, and you refer to, you alluded to deflation in a sense. Like in the last 4 years, I think inflation was approximately 22%, which is the largest increase in a 4-year time period of my lifetime. Now, there's no real going back, right? Like the only thing that really you can maybe stabilize inflation and have it at normal historical levels, but like we're not going to be in a position where we're seeing deflation. And am I wrong in saying that? And
Yeah, no, just remember three things. One, when the rate of inflation goes down, that's not deflation, that's disinflation, right? The rate is we've eased up on the accelerator, but we're still going forward. Energy prices were deflating until last month. I think that you have to remember that. Remember that for 3 decades, basically, bonds were in a bull market, inflation was low, and we never thought about it. Like, a lot of brokers on here can remember 16% mortgage rates, if you go back to the 80s. So, and the third thing to remember is even at 7%, let's say, or even 7.25%, that's a lower mortgage rate than the average over the last half century, which is closer to 7.7. So when we say mortgage rates are high, that's not true. I know nobody wants to hear that, but keep those three things in mind. And it takes time. When you increase the money supply by 40%, which we've never done before. Remember, in the financial crisis, we gave the money to the banks. This time we actually sent checks out to people. And for good reasons initially, then it was overkill and did more harm than good. It's going to take a long time. And when the two biggest sources of inflation are housing and food, that's a real problem.
Michael, I want to get A, your predictions on rates, and B, in terms of property valuation. One of the stats Greg mentioned is that ever since rates have gone up, ironically enough, prices have, either stabilized or maintained levels or increased. I can tell you throughout most major markets in the country, housing prices have gone up, single digits, but single digits on an annual basis, which is kind of counterintuitive, right? Like if I'm looking to purchase $1 million home and my interest rate is 3%, and I'm looking to buy that same home 2 years later at 7%, why is that home still $1 million? Can you explain that?
Yeah, I mean, Greg, thanks for all of that economic mumbo jumbo. I still want to know when rates are going to be at 5% again.
Has hell frozen over yet?
Yeah, I mean, I think, well, going back to the middle of 2022, when we first started seeing rates so high, I mean, it was kind of a shock to the system. But it was, one of the biggest surprises that I've kind of experienced in my career is that, I thought that the logical next thing was that prices were going to have to decline because there would be, demand would be on the sidelines waiting, buyers not wanting to pay 6.5 or 7% when they just, in their minds saw so many 3 and 4%, they would jump back in the market only if they were getting a 10 or 15 or a 20% discount. That seemed logical to me in the middle of 2022, and that was certainly a wrong call. So, what happened was that enough enough of the inventory got locked up by those low. And so if there's enough sellers not selling because they're locked into the lower rates, then you're just still going to get supply level that that where buyers have really no choice, and they have no option to see a lower value. They're gonna, they're still competing with 2 or 3 or 5 other buyers, and we see that particularly still in the suburbs, where there's one house for 5 buyers out there looking for it. So at this point, I think the interest rate, the mortgage interest rate environment, I think has kind of been absorbed in the minds of the buyers, and so they're just out there looking to see what still makes sense in terms of value. So there's there I think most of them are realize now that next month or 3 months from now or 6 months from now, they're not going to see the kind of low mortgage rates that they missed out on. So now it's just a question of where to find value. If you're not finding value in the mortgage rate, can you find value in what's being offered on the market? And if we're seeing kind of a stagnant level of sales volume, I think it's because there's not enough buyers seeing seeing value in what the sellers are still currently. So there's still that kind of push and pull between the sellers' expectations for value and where buyers want to be, relative to the mortgage rates they're paying, and what prices and what they perceive as value. We see that in particular in the co-op market, where we still see it's a surprise to owners and to sellers where we're doing an appraisal, and if they haven't done a substantial renovation in the last 1 to 5 years, they're surprised that the value today is about where they were in 2012, 2013, 2014. It's been about 10 years now of where you're going to see a lot of no growth in value unless there was a substantial renovation. So the buyers are, let's say, at the number of 2013, but the sellers are probably 10 or 20% higher than that. And so there's still that kind of dynamic in play, and I think it will be for the rest of this year, where the buyers are accepting they're not going to get a 5.5% or 5.25% mortgage rate this year, but where can we transact where the sale price or going into the sale price looks like relative value, and at least in the co-op market, relative value looks like numbers that we saw 10 years ago.
Michael, you're mentioning that, kind of alluding to that prices have been flat, especially in the co-op market in the last decade. What do you think in the next 10 years? Is there 70% of our inventory in New York City's co-ops? Do you anticipate, I mean, are they just plateaued?
I think in for a large segment of that market segment, yes. I think that what happened in the last 10 years, and when we had this inflationary period, post-COVID, the cost of renovation, the high cost of renovation basically eroded any growth over that 10-year period. So, I mean, normally, what do we look for, in any type of housing? 2 to 3% growth per year is, a long historical norm for housing. And so that, so it basically is supposed to keep pace with inflation. It's not, returning you 5 or 10% a year. But that pace of keeping up with inflation for the growth of housing prices really got eroded in this market, at least, by the cost of renovation. So the housing stock for co-op, tends to be older and larger, and in particular when you're talking about pre-wars on the Upper East Side, for example, you're talking about not just the high cost of renovation, but there's a cost involved with onerous rules and regulations to have those renovations done. So I don't really see I think that as I said, the numbers for a lot of those we see that people have no growth in value for 10 years or even 12 years. They're at about the same place, unless there was a significant investment in a new renovation to get that to today's modern level. So yeah, I mean, I think I see that segment being weaker because it's just used to the older products.
And Scott, we're talking about rates, pricing, affordability. Obviously, not everybody's paying cash. How are you, talk to us from a financing perspective, how are you getting deals done in a market like this? How are the numbers make sense to people? Are you seeing alternative measures of financing? Like I always say, not and people when they say I bought cash, majority of them aren't buying cash, right? They're just pulling lines of credit secured against other assets. Like, what are you seeing from your end?
So, I mean, there are a couple of ways you can engineer a rate down. Well, there are a few ways. One is with relationship. The luxury market and the affordable luxury and the luxury market, let's call it, broadly defined, has the opportunity to move relationship over to banks, and that relationship is worth, depending on the size of that relationship, meaning deposits and or investments, various tiers of rate discounts. And so, we're seeing, the market move in that direction. Not only are banks, more inclined, to do more loans and be more flexible on a whole variety of fronts, including underwriting and pricing where there's relationship, but for the consumer public, it's a way to get your rate down to a more manageable level. The second thing that folks are doing is instead of amortizing their loan, they're going interest only, which has historically always been a preference for the luxury market because of opportunity cost. They'd rather deploy capital into the market as opposed to pay down principal, particularly if they put a big down payment. They've made a big investment in the real estate up front in the first place. And then the last piece would be you could buy rate down with upfront points. So you can pay to buy the rate down. There's a natural break even. Typically 1 point gets you a quarter in rate reduction. 2 points gets you a half a point in rate reduction. The natural break even on that is typically 4 to 5 years. So if you're planning on being in an apartment or a house for more than 4 or 5 years, it can make sense to buy the rate down and beat the bank out of interest expense. Beyond that, there really, isn't, a whole lot more, that one can do to manage against, the higher cost of capital today. But those are three techniques that are very effective and are being highly utilized today.
Yeah, and I think it's important for people to know that because, if you're able to utilize all of those options, you can potentially get a rate down, 100 basis points, 75 basis points. We have a lot of clients, we're talking about rates being, 6.75, 7%. We have a lot of clients who say at the closing table, oh, wow, you got 5.75. How'd you get that? You just explained how you got it, right? 100 basis point differential rates is tremendous difference from an affordability perspective. And I think it's something that, the market needs to be more aware of, that is available. We just can't rely upon the mass emails we get or what we see on the internet in terms of, oh, here's today's rate market. That doesn't necessarily apply for the vast majority of our clientele here. So I think I really appreciate you, highlighting that point. Two things I want to talk about, when the first part pertains to our local market in New York City, and the second one more from a national level. Development. Let's focus on New York City for a second. When our market largely has been driven by new development over the last, 15, 20 years, and we've seen a significant slowdown of that. And I think in particular in the last decade, most new development that has come into the market has been ultra luxury, right? Like with 57th Street being transformed to Billionaires Row in the last 10 years. What's happening in the new development market in terms of additional product being brought on? What's going to get developers to develop? Are there opportunities left? Have we developed Manhattan in particular to the greatest extent we can? Is there any land left? Now you can't buy a rent stabilized building and destabilize it and convert it to luxury condos. What's going to happen with new development? Anybody? Your choice. Who gets to jump on that one?
I would just offer up a couple of observations. You know, one is that you know, we are, you know, as supply constrained as we've been in New York City on the new development front since 2015, and I think there are something in the neighborhood. Greg would probably have a better handle on the exact number, but something in the neighborhood of 900 units of new development available, not including shadow inventory. If you include the shadow inventory, maybe that number doubles. But that you know is contrasted to, you know, a more typical level of inventory, you know, in the 4,000 to 5,000 units, you know, available at any given time, you know, on market. So there's and that's also further distorted by the fact that you've got two mega projects, one Wall Street, which has 450 units, Waldorf, which has over 400 units. You know, so you back out those concentrations, and you know that the supply constraint becomes even more acute. So you know, I think that there's a real dearth of new development inventory, and I think, you know, I don't see that changing, you know, anytime soon, because everything is so much more expensive. Construction loans have, you know, substantially higher you know, costs of capital associated with them. Labor, materials, you know, land, everything is more expensive, and it's hard to make the numbers pencil at current exit values. So A, we're very supply constrained at the moment. B, everything is so much more expensive. It's hard to relative to the exit value opportunity, it's hard to make the numbers pencil. So I think we're going to be supply constrained for a bit.
I think also, you know, the city and the state haven't been helpful in this regard. You know, people are building super luxury projects because that's the only way the numbers work. You know, the changes to 421A, now 485X, which, you know, any expert will tell you that, look, we want more affordable homes in New York City, and those are rentals, right? Because roughly 70% of the people in the city are renting. But the requirements on 485X are so unreachable that it's not going to deliver a lot of housing, even on the affordable level. And it's not about land. And the other thing is, you know, everybody's talking about converting office to residential, like we saw, you know, 30 years ago with the Lower Manhattan plan. But massive incentives. You got an exemption and an abatement with 421G. Like that really helped erase a 25% downtown vacancy rate in office buildings. What we know now is two things that we didn't expect. Number one, at least the Class A office market is doing wonderful. You know, it's, you know, the vacancy, there's an article in the Post today about how in the Plaza District here, there's no space. Now you say, well, those aren't the buildings we're talking about. Okay, well, the buildings that are the B buildings that you think would be right for it, if you talk to any expert in this, they'll say there's too much work that needs to be done. The layouts don't fit. You know, downtown, they were chic buildings, you know, they had a feel to it. Today's climate, you know, there's a couple of them going forward, but not as much as we would like. So you can always find sites. But as you know, a lot of these buildings now, these sites are assembled over years. And it also didn't help, and this is still going on to a lesser degree, that certain politicians are pushing for a pied-à-terre tax. You know, this idea that just because you don't live here full time, you should pay additional taxes. Although apparently France is trying to do 100% tax on foreign bought real estate. Interesting. But, you know, the amount of revenue, I know people say we keep building super luxury towers or second homes to people, hedge funders, whatever, celebrities. But the amount of tax revenue that generates fills the city with money and the state with money to spend, you know, to keep the city running. And you need that construction, those construction jobs. So I don't know how it changes. The city has made it clear they don't want to offer any incentives for market rate developments outside of zoning changes, because those are free, right? You're not, you know, the whole city of yes is a great idea. You know, I hope it continues to foster development, but you talk to any developer now and, you know, they're being very picky.
Yeah.
You know, Michael, before jumping to you, one part, Greg, I wanted to, you know, piggyback off of. You're talking about incentives to developers and rezoning. One of the things that took place years ago was an initiative to create more affordable housing, which is a huge crisis in New York City. That if a developer wanted to get a tax abatement for the property, depending where you were zoned, 20 and 30% of the units in that project had to be designated for affordable housing, which I thought was great. Which I thought was a great initiative. It accomplishes a number of positive things. Now, is that something that you've heard is back on the table? Why isn't that something being pursued? Because it seems like it'd be a great formula to address a lot of what we're talking
Well, I mean, this was what the shift towards rental development, 421A at the end, which had extra benefits for 80/20 buildings. You got an extra like 5 years, I think it was, in certain areas if you build enough affordable units. Now it's all about rental construction, and we can't build rental apartments fast enough. Rents aren't skyrocketing anymore, but they're not going down significantly either. And I think that's a problem, especially as mortgage rates are elevated, which makes purchasing harder for that first-time buyer who probably will look at the co-ops because they are more affordable. It makes, how the city can house, especially with the immigration that has come in here, is going to be very challenging, and at least the mayor is trying. Remember, the city can't change these tax laws. The state has to do that. And that sometimes, a lot of times over the last couple of decades, we haven't had a good relationship between the mayor and the governor. So we'll see what happens with that. But, this is a very progressive government we have at the city and state level. We saw that with the rent regulation laws and what they've done there. And then they're surprised that upwards of maybe 50,000 apartments are being warehoused because it doesn't make sense to repair them.
about. That's right.
You can't even call it an unintended consequence because they knew it was going to happen.
Right. Michael, what are your thoughts?
Yeah, I was going to say that, I agree, going back to what Scott said, is that, we really are kind of at the tail end of this most recent development cycle. And just, remember, the development cycle can be like 10 years long from the time that somebody plans and acquires and assembles a project, gets it approved, gets it built, and then puts it on the market and gets, all the units sold. It's a long period from original assemblage to sellout. And in between that period, there's usually another, market period where the next phase of development is planned. And, as Scott mentioned, that the cost of getting a construction loan, the returns that are required for the equity partners, the labor, the rent, the cost of construction, everything has gotten so much higher that, it's hard to make sense of the project going forward. So I think in the next, 1 to 5 years, we are looking at a period where are these new units going to come from? And they may come from some of the initiatives with the city of Yes. They may come from rezoning in some areas. But it's hard to see. It's hard to see if you're talking still about market rate developers going out, buying property, basically to demolish a building and acquire it for a land value. You're still talking about land value so high that you're still going to see ultra luxury product being the only thing that makes sense. So we got to find a way to kind of get the more pedestrian middle of the market involved, so that everything doesn't need to be sold out at 3,000 a foot, that we can go back to projects that make sense at 1,500 a foot.
Michael, can you talk a little bit more about the city of Yes and what the mayor is trying to accomplish with this?
Yeah, I mean, there's a lot of components to it, and I think a lot of the zoning lawyers and the zoning experts are still trying to figure out what exactly it will mean. So I don't think that you're looking at a part of it is really about existing inventory and how you might be able to add a few housing units to what's existing there. So whether it be a basement apartment being approved, or to zone up for another story or two that you can expand an existing building. So there's not a much there isn't enough detail yet about what it means for, let's say acquiring a building, a two-story building in Midtown, where maybe you can put 20,000 square feet there. Can you get, would the city of Yes get you to 30,000 square feet? So there's still, it still kind of needs to shake out as far as what it might do for a new development site that has a certain amount of as of right buildable, and can you get a bonus from that? So I think the focus on the city of Yes is really where can we add, 1 to 5 extra units in something that's already existing. So I don't think that really is going to impact the next round of new development and the next cycle of new development. But yeah, different rezoning of certain areas where you're really going to go from, let's say, manufacturing to being able to build residential, something like, the biggest initiative in the last, 5 or 10 years was the Gowanus rezone. And so you're going to see a huge explosion of new buildings going up and around, the Gowanus area. It's going to, look like a little city, like Long Island City sprouted up. So the question is, where's the next zone that's going to have kind of a really impactful rezoning effort that's, that can, reshape a market area for the next 5 years.
And then now shifting the focus to more of the national market, right? Because obviously that has impacts on our market here in the overall economy. When you look at housing transactions in the last 2 years, 2024, 2023, they are roughly at a 30-year low in terms of volume. And again, there's no secret, that it's not all interest rate driven. But, interestingly enough, prices in most markets, like they did in New York City, either maintained their values or increased slightly. Now that's pure supply and demand. We have, we talk about a shortage of affordable housing in New York City, in the future of development not being as robust as what it once was. We have a massive shortage of housing in this country. Massive. I know all of you, focus predominantly in the New York area, but also have, parts of your business that are all over America. Right now, the stat varies, so don't quote me on this precisely, but generally you read that we're roughly 5 million homes short of current demand levels, which is staggering given the cost of debt. Now, how do we solve this problem for incentivizing housing development in America? And what's being discussed? What could be done? How do we create more supply?
Well, the other thing we forget about is this idea, and this economist I follow always talks about it, scrappage. Homes only last a certain amount of time, and one of the things that's interesting, the existing home sales have been really running hot because of that lag between, when rates got low through the end of September, that's pushed up the numbers. So there's only, I'm looking at the exact number, I think it's 3.8, right, supply. But for new homes, the number's much higher because the price points are much higher. Again, it's not just New York and Manhattan where the only thing they can afford to build is luxury units. The other problem too is that hedge funds have been buying up hundreds of thousands of single-family homes in the United States and even creating their own towns. Like something out of Oppenheimer, where they just, BlackRock or whoever can go in, and it's like, okay, we're just gonna build, and they rent them out. Now that you could say, well, that's good, but that shows you that it's hard. I mean, the home ownership rate isn't incredibly low. It still sits around 65% in the United States, but it's a problem. And now people are worried because, potential deportations, what that's going to do to the supply of labor. I don't really think that's going to be a big problem because the deportations I'm hearing about aren't necessarily centered around people that are working in construction. But I guess, and the cost of materials and what tariffs could do to that. Obviously, remember, we saw some ridiculous increases in the price of lumber and copper and a lot of commodities during COVID. So I think there isn't a shortage of land, though, in many parts of the U.S. I have a brother in Texas. I can tell you there's plenty of land there. North Carolina, Virginia, you go to these in the South and the Midwest, there's plenty of land. The question is, do they have buyers? And with, you know, the so much more people working remote, they can live anywhere. So we can build a housing anywhere. We don't have to focus it necessarily around cities. But, you know, there's a couple things that the government could do. One of them is being discussed now, and, you know, that's to at least help from the demand side, is raising the SALT cap, right? Because people in this part of the country and California obviously has a bigger problem right now. You know, it's funny that the Republicans are talking about, they're the ones really pushing for this, for the most part, maybe because they're going to have a sympathetic president. But the Democrats could have changed this. They didn't do it when they had the opportunity. Part of the problem is tax reform is really helping lower the taxes of most Americans. But now there's talk of raising it from 10,000 to 100,000. That'd be a big boon, and that would probably foster construction. So I think that's part of it. But a lot of it can't be helped. You know, just like, you know, we've talked about construction loans being more expensive, materials are more expensive, labor is more expensive. So what are you going to build other than expensive homes? And without, I mean, again, tax incentives was the way it's been done in many parts of the US for a long time. And if you don't want to do that, okay, but you see the results. And the other thing is, you know, trying to say where things should be built. You know, in New York City, they used to let you write a building like 15 CPW got 421A because it bought certificates in other parts of the city. Then they said, all right, you can't do that anymore. You know, you got to put it where you're putting your building. And I guess there's certainly an argument to be made for that. But they have to come up with better ideas, because the land is there, the demand is there, you know, and the private sector can't do it all by itself when it's looking at what labor costs are. 485X, one of the biggest problems is there's a minimum hourly rate that you have to pay that is significantly higher than what you would pay for general laborers, you know, people that aren't skilled tradespeople. So you're not going to hire those people. If you have to pay such a high rate, you're going to hire, you know, specifically trained people, even to do menial work, which is ineffective and is going to cost jobs. I think a lot of times they try to, again, they don't think about the unintended consequences of some of the rules they put in place. But, you know, nationally, they didn't have that 3-month pause where everything was closed in March of 2020. They opened up right away and things sold like you wouldn't believe. And you know, there was a time when the supply of homes for sale was sitting at about a month. We measure time on the market. A lot of times we look at it in days, but there were times right in the wake of COVID that you could have measured it nationally by hours. I mean, it's insane. And that's why higher rates, fewer sales, prices aren't going down. It doesn't make sense unless you look at the supply levels being so low that sellers can wait it out. And that's the vast majority. I live in Long Island. It's still ridiculous. You know, you go to Westchester, you can look at Connecticut. You know, it's not a good time to be a realtor in those areas because there's so little product for sale. It's very hard. So they have to find a more massive, you know, program to get homes built. Look, the governor in her State of the State address has talked about this a little bit. I haven't heard Trump say much about it directly, but we'll see.
But the SALT cap's increase from 10,000 to 100,000, it presumably drives up housing prices in the suburbs of New York now.
Maybe. I mean, the question is that really preventing people from buying in those areas?
Which I love you bring that up, because in 2016, we all thought the world was ending in predominantly the burbs of surrounding New York with that SALT deduction. You know,
and the prices have never been higher.
Exactly.
I think for the co-op segment, though, that would be a great thing for the co-op segment.
Yeah.
Because, you know, if you're talking about, you know, one of the problems is going back to that co-op segment is that maintenance is so high. And, you know, if you're paying $10,000 a month in maintenance for some of those larger co-ops, and, you know, you're limited to 10,000 deduction, if they increase that, I think that would be, you know, that would help get some growth and co-op values going forward.
Scott, what are your views? Like you're lending all over the place. What are you seeing different from lending in the New York area to lending in other parts of the country? And what are you seeing in terms of, additional supply being created in different markets?
So I think, one of the things that's going on one of the things that differentiates New York City from other parts of the country is the fact that the inventory is, co-op and condo. And there continues to be, a lot of chaos around collateral approval, whether it be, new development because of presale, or existing inventory resales that are mixed use, heavily multifamily, or lots of commercial on the ground floor. There's a lot of and now with the DOB designation of unsafe in the wake of Surfside tragedy, where if there's any structural deficit, in a building, it doesn't just get noted, as part of an updated TCO or CO. It actually gets reflected on the DOB website as an unsafe building, which makes it unlendable. So, New York has always been a little bit unique, because there's collateral complexity that gets added to the mix, as opposed to just, Michael Vargas doing an appraisal on the house, and as long as the value comes in purchase price, all is well. In New York City, you're approving, the co-op or the condo, to the same extent that you're approving the borrower personally. And New York has there is a larger percentage of more complex types of collateral than ever before, because it's what helps make developers pencil the numbers, adding commercial to the ground floor, doing a mix of rental and for sale condo, all of which, I think is great. And, we're very comfortable with those types of complex collateral profiles, but not all banks are. And, there's some banks can get twisted in a pretzel, over something that's not 100% co-op or 100% condo. And then the other thing that's new, that's creating complexity and a fair amount of agita is this new DOB unsafe designation, that's throwing banks for a loop, and a lot of banks won't lend, if that designation exists. What we will do, and what some other banks, will do, they're taking, a sophisticated approach, is based on the ability to work with the board and the board's attorney to prove out, tangible progress towards addressing whatever the structural deficit is and eliminating that unsafe designation. If there's evidence of that, and it's documentable, then we'll make an exception to financing the building, notwithstanding that unsafe designation. But that's not consistent across the board.
So we have 4 minutes left. One question I wanted to popped up on my message board. I think it's really interesting. One of our practice areas, we represent a lot of co-op condo boards, general counsel, and co-ops in general take underlying mortgages to create liquidity and cash to conduct certain improvements and operations of the building. Those mortgages are very low loan-to-value ratios in comparison to the value of the building, but they're 10-year terms, and a lot of them were refinanced in 2014, 2015, coming up for maturity at probably a lot higher of an interest rate. Now, I'm going to kind of add my own anecdote to this question, because you're going to have the increased interest on underlying mortgages for buildings, and you're also having a huge problem in the insurance world. For the reason you're describing, Scott, like insurance premiums in every segment of insurance have skyrocketed. Everybody here who has a car, your auto insurance went up, and it's not because you got a parking ticket in New York City. It's because insurance companies are suffering from all the natural disasters and spreading the cost amongst every avenue of insurance they issue. So, property insurance in particular has gone up significantly. When you're talking about the increase in cost for insurance for a building, the increase in debt service underlying mortgage, and the increase in insurance for the consumer, how do you expect that impacts the market moving forward?
It's going to be a big problem, in the co-op segment in particular. And so again, you're talking about a buyer or a potential new owner facing, their own high mortgage rate, and then the maintenance of the co-op being substantially higher because of all of those costs that go into maintenance. So, maintenance is basically paid to cover all of the building expenses, including debt service and insurance and, the staff and all of that. So everything's more expensive. Maintenance continues to go up. So there's, there's a good amount of downside risk for not just co-ops, but also for the older condos. There are also older condos that they don't have an underlying mortgage, but they have a lot of, they may have upcoming capital repair projects that are pretty substantial. I'm talking about, condo buildings that were built in the 80s and the 90s, for example. A lot of those are coming up with major capital repair projects that are going to be needed.
Yeah.
You're just talking about much higher carrying costs in the city for co-ops or some of the older condos, and that's really going to weigh on the ability for prices to advance forward.
By the
Yeah,
way,
it's definitely something I think we all have to.
if you want some good news, I'm looking at the tentative assessment roll that was released yesterday. By the way, I encourage everybody to go to the DOF's website. If you have an exclusive, look at the notice of property value. I don't know if they've been posted yet, that'll give you the prediction for taxes starting July 1st. It's based on the proposed assessed billable AV and the current tax rate, so it's not 100% perfect. But according to this, on an aggregate level, even though market values for co-ops, I don't know where they get this from, because they use rental comps, rose about 5.4% this year versus last year, but billable AVs are only expected to go up a little over 2%. So that's good, because taxes have always been a huge problem. Obviously, I live in Long Island. They're ridiculous there, and Westchester, and so many parts of this region. But maybe, there's some relief there. There is always tax reform looming. There's an interesting op-ed in the Post today from the people that really pushed to get the Tax Reform Commission together. COVID kind of put a monkey wrench in that. But some of the proposals would be devastating to certain segments of the market. I'm not saying they make sense. They don't make sense. The property tax system is crazy. Some of the people that benefit from it and some of the people that get hurt by it. It does need to be reformed and simplified, but it looks so far, condos are only slated to go up about 2.2% in billable AV. That doesn't mean every building's going to see that change, but again, remember the crazy way we value co-ops and condos is using rental comps. And you can go on the DOF site and see which rental buildings were used to value your co-ops and condos. I don't know if you're going to understand any of it, but it's there.
Well, I like to always end on a positive note. So hearing that taxes aren't anticipated.
If you're going to rely on the economist to leave people with a smile, you got problems, buddy.
Yeah, that's a good one. Well, we'll end on a joke too. But before doing that, I just want to talk about a couple quick things. Our next live CE class will be the morning of Wednesday, February 12th. We're actually going to go, I'm bringing in a social media marketing expert to talk to us about how the real estate brokerage community could utilize social media to gaining traction with potential buyers and sellers, and for marketing your brands, which is something interesting, something I'm interested in learning more about myself. This class, after today, you will get an email with a promo code. As a participant for today, everybody who attended gets a discount code for all of our online offerings on our website. So please take advantage of that. It's applicable to our bundles and individual classes. I do want to really send my sincere gratitude to Greg, Michael, and Scott for taking the time. I know you're really busy people, and appreciate you carving out time this morning to talk to everybody. I think the insight was incredible. This is our first actually time doing this topic. So I don't know if any of you knew that, but you were my guinea pigs on this concept. And I think it was fantastic. I do think there's a lot of things that we need to continue monitoring. I'm hopeful to do this every quarter so we can, we'll look back in time and, hindsight's always 20/20 and see which one of our predictions was right and which one was asinine. So thank you guys again for your time. Thanks everybody for attending today, and hope to see you on our next class on the 12th. Thanks, guys.